Today, we're doing a complete breakdown of ASC 350-40. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine a tech company spending $10 million on software, and everything was expensed immediately without clear capitalization rules. ASC 350-40 changed this by providing detailed guidance on internal use software costs. This section equips you to understand the rationale behind capitalizing software development costs, creating consistency and accuracy in financial statements. ASC 350-40 provides the necessary framework for determining when to capitalize software development costs. Before its introduction, companies faced challenges in consistently accounting for these expenses. Now, costs incurred during the application development stage must be capitalized, resolving past inconsistencies. This standard not only boosts financial statement comparability, but also enhances the reliability of financial information for investors. ASC 350-40 affects any company developing software for its internal use, making it relevant across industries. Implemented since 1999, it establishes that costs incurred during the application development stage must be capitalized. This ensures financial transparency, distinguishing between costs that can enhance the balance sheet and those that should be expensed. Understanding these distinctions is crucial for accurately reporting software-related financials. The internal use software model is pivotal in financial reporting, focusing on capitalizing costs during the application development stage. Companies must differentiate costs into stages, capitalizing only those incurred during development. This approach impacts the balance sheet, reflecting software as an asset rather than an expense. Knowing how to apply this model demonstrates a deep understanding of cost management in software projects, a valuable skill in finance roles. Miscalculating scope can be costly. Many forget that costs for software developed for sale aren't covered here, a classic interview trap. Scope determines what costs are capitalized or expensed. Missing this can skew financials. Here's why getting it right is critical. Understanding what costs ASC 350-40 covers can significantly impact financial strategies. Costs for developing internal use software are capitalized, unlike operational expenses. For example, adding a new feature to a CRM system falls under this scope, transforming the project cost into a capital expenditure. This decision shifts financial reporting from immediate expensing to amortization over time, which can affect KPIs like EBITDA. ASC 350-40's exclusions are critical for accurate financial reporting. For instance, costs for software intended for sale are expensed, not capitalized, preserving revenue recognition clarity. Training expenses fall outside the scope, ensuring they remain operational costs. Recognizing these exclusions helps avoid common pitfalls in financial audits and maintains compliance with regulations. For example, misclassifying training as development could inflate asset values erroneously. Internal use software is tailored exclusively for a company's operations, separating it from commercially sold products. Consider a company developing its own CRM. The costs of tailoring it solely for internal efficiencies are capitalized, impacting both balance sheets and capital budgeting. This approach allows businesses to match software investments with strategic goals, ensuring that financial reporting accurately reflects the internal value generated. During the application development stage, costs are capitalized, transforming them from immediate expenses to assets. This affects asset valuations and future depreciation schedules. For example, when a company adds new functionality to its ERP system, these development costs are capitalized. This shift not only changes the balance sheet composition, but also affects EBITDA by deferring expenses over the software's useful life, providing a clearer view of operational performance. Understanding edge cases is essential for mastering ASC 350-40. Consider upgrading a licensed CRM used internally. This falls within scope as it enhances functionality. However, costs for training staff on new features are excluded. When software is developed for sale, upgrades don't apply. Bundled hardware costs with software installations often ride the line, but aren't typically included. Clarifying these nuances ensures precise compliance and accurate financial reporting. Imagine navigating the complexities of software accounting with ease. The internal use software model provides a structured approach, ensuring clarity in capitalizing and expensing costs. This model is vital for companies dedicating significant budgets to software development, such as a $10 million SaaS contract. Understanding it ensures precise financial reporting in an increasingly digital age. The internal use software model is essential for companies developing software for internal use. It guides the accounting treatment of costs through distinct project stages. In our example, Meridian Corporation has a $10 million SaaS contract with an $8 million software license and $2 million for implementation. By following this model, Meridian can accurately determine which costs to capitalize or expense, ensuring compliant and transparent financial statements. Meridian Corporation's $10 million contract includes software meant exclusively for internal use, aligning with ASC 350-40. This step ensures the $8 million software license supports internal operations, not external resale. The common pitfall is misclassifying dual-use software, which muddies financial clarity. Meridian's successful determination here paves the way for accurate cost assessment in subsequent steps, confirming its primary internal usage. After establishing that Meridian Corporation software is solely for internal use, the next step is determining the project stage. Meridian's $10 million SaaS contract involves $2 million for implementation, which needs precise stage categorization. Missteps here can lead to incorrect financial reporting. Correctly identifying stages ensures the right costs are capitalized or expensed, maintaining financial integrity. This groundwork is crucial as Meridian moves forward with capitalization strategies. Meridian Corporation now identifies costs from the application development stage for capitalization. This involves capturing direct software development expenses from the $8 million software license. This classifying operational costs here can distort asset values, misleading financial analysis. By capitalizing correctly, Meridian ensures its balance sheet reflects an accurate software asset value, setting the stage for consistent financial tracking and reporting. Meridian Corporation must now expense costs from preliminary and post-implementation stages. This step ensures that asset values aren't inflated by non-capitalizable costs. Following the precise identification in Step 2, Meridian accurately expenses these, reflecting true software-related expenditures. Confusing these with capitalizable costs can lead to misleading financial statements. Proper expensing here reinforces consistent and transparent financial reporting, crucial for strategic decision-making. For the final step, Meridian Corporation ensures its $8 million software license remains accurately valued. Regular impairment assessments check if the software's carrying amount exceeds its recoverable amount. Failing to reassess can overstate assets, impacting financial credibility. By consistently evaluating for impairment, Meridian aligns its financial statements with the software's actual value, ensuring transparency and compliance with ASC requirements. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 350-40 requires specific disclosures, ensuring stakeholders understand how intangible assets are measured, enhancing transparency. Let's unpack how your choices affect financial statements and why accurate reporting is crucial for trust. To recognize an intangible asset, ensure it's identifiable and controlled, recording it at acquisition cost. For instance, a software license acquired for $20,000 meets the criteria. Capitalize this amount if it exceeds $5,000. Recognition hinges on probable future economic benefits, establishing a firm foundation for asset valuation. Once recognized, intangible assets require careful subsequent measurement. Amortize over the asset's useful life and reassess annually for any changes. An $80,000 software system may see annual amortization adjustments if its useful life changes. Impairment testing ensures assets aren't overstated, maintaining balance sheet integrity. Intangible assets appear as non-current assets on the balance sheet. Amortization is reflected as an operating expense on the income statement. Disclose policies in notes for transparency, clarifying how assets like a $100,000 patent affect financial health. Proper classification ensures accurate understanding of asset utility and financial stability. Disclosures under ASC 350-40 ensure stakeholders grasp the intangible asset landscape, detail the nature and life of assets, aiding analysts in calculating valuations. Amortization methods provide comparability, while impairment testing results highlight any potential issues. Reporting revaluations offers a clear view of asset value changes, vital for informed decision-making. Imagine a CFO handling a $12,000 software upgrade. They must decide to capitalize or expense based on future benefits. Recognizing this asset requires probability and measurability of economic benefits. Annual impairment testing ensures the asset's value is not overstated. Accurate, timely disclosures prevent misrepresentation, maintaining investor trust and financial credibility. Meridian Corporation, a global manufacturing company, embarks on an ambitious software development project valued at $750,000. Watch as we meticulously track every financial event, from initiation to recognition and beyond. This journey highlights the complete accounting treatment under ASC 350-40. Initial costs of $200,000 incurred during software development are capitalized according to ASC 350-40. This accounting treatment recognizes the future economic benefits expected from the software. Meridian's balance sheet now reflects an asset under development, indicating the project's potential to generate future revenue. As Meridian incurs another $150,000 in development costs, these are capitalized, increasing the total asset value under ASC 350-40. This reflects the ongoing creation of an intangible asset, with the potential to enhance future business operations and profitability. Meridian starts amortizing the software over its estimated useful life. The $70,000 amortization expense reflects the asset's consumption, aligning with ASC 350-40 principles. This periodic expense matches the software's utility against generated revenues, impacting both the income statement and balance sheet. Another $100,000 invested in the software project is capitalized, reflecting Meridian's commitment to enhancing the asset's functionality. Under ASC 350-40, these costs are treated as an asset, anticipating future benefits. This strengthens the asset's value on the balance sheet, while ongoing amortization balances its expense recognition. The $140,000 annual amortization recognizes the systematic consumption of the software's value. This expense aligns with ASC 350-40, representing the software's contribution to the company over time. Amortization reduces the software's book value while appropriately matching expenses with revenue generation. Meridian recognizes a $50,000 impairment loss due to technological shifts impacting the software's utility. ASC 350-40 mandates impairment testing to ensure assets are not overstated on the balance sheet. This adjustment ensures a realistic reflection of asset value and future economic benefits. As Meridian concludes the software project, a final $30,000 amortization expense is recorded. This ensures all costs are matched with the benefits derived, adhering to ASC 350-40. Final adjustments align the asset's book value with its remaining utility. Derecognition of the software asset is completed as it's fully amortized. The $450,000 accumulated amortization matches the capitalized cost, closing the asset's lifecycle. This final step ensures that Meridian's financials accurately reflect the asset's economic consumption, per ASC 350-40 requirements. Every Big Four and investment bank interview on ASC 350-40 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 350-40 is the standard for accounting software costs. It guides when to capitalize or expense costs incurred in the software development process. The key is understanding the 3 stages: preliminary, application development, and post-implementation. Many confuse which costs belong to each stage, so remember, capitalize only during application development to avoid misclassification. ASC 350-40 exists to provide consistent guidelines for capitalizing software costs. Without it, companies would vary widely in how they account for software, leading to inconsistencies in financial statements. It ensures that costs are reported accurately, reflecting true economic activity. Remember, consistency in accounting practices enhances comparability across entities. Once development is completed, software costs are amortized over the software's useful life. The amortization should begin when the software is ready for its intended use. A common mistake is starting amortization too early or too late, which misstates expenses. Key takeaway: amortize when software is ready, not before. One key difference is how costs during different development phases are treated. Indian accounting standard may require immediate expensing of certain costs that ASC 350-40 allows capitalizing. This discrepancy can affect financial results significantly, especially for tech companies. Remember, understanding these differences is crucial for multinational operations. ASC 350-40 focuses more on capitalization criteria, whereas International Financial Reporting Standards provides broader principles. Under International Financial Reporting Standards, judgment plays a larger role in determining capitalization eligibility. This can lead to variations in reporting. Remember, ASC offers specific guidance, while International Financial Reporting Standards requires more interpretive application. Always consider the jurisdictional impact. Only costs during the application development stage are capitalized, which totals $200,000. The other $300,000, incurred during non-capitalizable phases, should be expensed. Misclassifying these costs often leads to inaccurate financial statements. Key takeaway: ensure only eligible costs are capitalized to avoid overstating assets. Preliminary project phase costs are often misclassified. Companies mistakenly capitalize these costs, expecting future benefits. However, ASC 350-40 mandates expensing them. This error inflates asset values. Remember, preliminary costs are exploratory, not directly tied to application development, so they must be expensed. Avoid this scope trap to ensure compliance. The CFO must disclose the nature and amount of capitalized costs, amortization methods, and useful lives. Transparency ensures stakeholders understand financial impacts. Omitting these can mislead investors. Key takeaway: detailed disclosures maintain credibility and compliance, emphasizing the importance of transparency in financial reporting. Many firms neglect regular impairment assessments, risking overstated assets. ASC 350-40 requires impairment testing if conditions suggest diminished software value. Ignoring this leads to misstated financials. Remember, regular impairment checks ensure assets reflect true economic value, aligning with accurate financial reporting standards. Understanding ASC 350-40 is crucial for managing internal use software costs. The standard outlines guidelines for recognizing and capitalizing software costs intended for internal operations. It emphasizes the importance of identifying stages like the preliminary project, application development, and post-implementation. Capitalization of costs begins only in the application development phase. Mastering these basics ensures accurate financial reporting and compliance. The internal use software model under ASC 350-40 requires identifying phases for proper cost treatment. Initial planning is expensed, while development costs are capitalized. Post-implementation costs like training are expensed. Capitalized software's amortization aligns with its useful life. Regular impairment assessments ensure that the carrying value is recoverable. This structured approach aids in precise cost allocation and financial reporting. Knowing the intricacies of ASC 350.40 can set you apart in interviews. Avoid common traps like stage misidentification and improper cost capitalization. Understand the distinctions between ASC and International Financial Reporting Standards, especially in capitalization clarity. Essential disclosures include software costs and amortization policies. Regular impairment checks prevent asset overstatements. Accurate identification of direct costs ensures proper financial reporting. These insights are vital for professional conversations and financial accuracy. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.